Hi, my name is Amit Mehra and I am working with the Akgvg and Associates as a manager, internal audit and SOX compliances. We will make sure that after our short and crisp session on the Sarbanes Oxley Act, you will understand the Sarbanes Oxley Act completely. Brief background about the Sarbanes Oxley Act. So the Sarbanes Oxley Act was named after the bill sponsors US Senator Paul Sarbanes and the US Representative Michael G. Oxley. The Sarbanes Oxley Act was enacted in July 2002 under the Public Company Accounting Reforms and Investor Protection Act. So first of all, we have to understand why the Sarbanes Oxley Act was introduced. Sarbanes Oxley Act was enacted on account of increasing the number of corporate scandals such as the Enron, WorldCom, Xerox, Farmore, Adelphia, Dinergy, CMS Energy. These scandals resulted in the loss of billions of dollars of investor money when the share prices of these companies collapsed and ultimately impacted the public confidence in the US securities market. So what is the applicability of the Sarbanes Oxley Act? The Sarbanes Oxley Act set the new requirement for all the US public companies, board, management and public accounting firms. These are the number of provisions also applies on the privately held companies. So what are the requirements under the Sarbanes Oxley Act? SOX Act contains the 11th section consists of the additional corporate board responsibility to the criminal penalties and require the Security and Exchange Commission to implement the ruling on the requirement to comply the law. The Sarbanes Oxley Act also cover issues such as the auditor independence, corporate governance, internal control assessment, and the enhanced financial disclosure. So let's discuss about the major elements in the Sarbanes Oxley Act. So the first one is basically Public Company Accounting Oversight Boards, which is known as PCAOB. PCAOB provides independent oversight of public accounting firms providing the audit services, that is the auditors, and the PCAOB also created the Central Oversight Board registering the auditors, find the procedure for compliance audits, quality controls, and ensuring the compliance with the specified mandates of the Sarbanes Oxley Act. So the second one talks about the auditor independence. It establishes the standards for the external auditors' independence and limits the conflict of interest. Also ensure that there is a requirement for a new auditor approval, auditor reporting requirement, and auditor partner rotation. This also debarred that auditing companies provides the non-auditing services to the same client. So the third element is talk about the corporate responsibility. It specifies the responsibility of the senior corporate executives for the accuracy and completeness of the corporate financials reports. For example, Section 302 requires that the company chief executive officer and the chief financial officer certify and approve the integrity of their company financial reports every quarter. Fourth element talks about the enhanced financial disclosure, describe the enhanced reporting requirement for the financial transactions. That includes off-balance sheet transactions, stock transaction for corporate officers. This requires that the internal control for ensuring the accuracy of financial reports and disclosure. Now talk about the fifth element, that is analyzes the conflict of interest. This contains only one section which consists of designing the activities to restore the investor confidence in the securities analyst reporting. So sixth element talks about the commission resources and authority. This consists of redefining the procedure to restore the investor confidence in the securities analyst reporting. So seventh element talks about the studies and reports. The Comptroller and Auditor General and the Security and Exchange Commission to perform various studies and report their findings on the effect of consolidation of the public accounting firms, role of credit rating agencies in the activities of the security market, enforcement actions, and others to manipulate earnings and present the true financial conditions. So eighth element talks about the corporate and criminal fraud accountability. It specified the specific criminal penalties for manipulation, destruction, or alteration of the financial records or other interference with the investigations, while providing certain protection for whistleblowers. So, ninth element talks about the white collar crime, penalty enhancement, This enhanced the criminal penalties associated with the white-collar crimes and conspiracy. It recommends stronger sentencing guidelines and specifying adds failures to certainly corporate financial reports as a criminal offense. So 10th element talks about the corporate tax returns. This section requires that the chief executive of the company should sign the company tax return. 11th and last element talks about the corporate fraud accountability. It identifies the corporate fraud and record tampering as a criminal offense and joins those offenses to the specific penalties. It also revises sentencing guidelines and strengthening their penalties. This enables the Security and Exchange Commission to restore temporary freezing the transactions or payment that have been deemed large or unusual. I hope this video was informative and helpful in understanding about the Serbian Auxiliary Act. In our next session, we will discuss about the implementation of the key provision of the Serbian Auxiliary Act.